Hello everyone, very good evening to all. Welcome you all in the YouTube channel of Oliveboard. I hope you all are fine and doing well. So those who are watching, please confirm my audibility and visibility once. Yes, everything is fine. So today we have to start unit number 19 and the name of the unit is hybrid finance. So we have completed, it is module D. Okay, it is module D. So we have completed our all three modules A, B, and C, and we have started from today itself our last module, that is module number D, and its first unit, the hybrid finance, unit number 19. From the word itself, it is clear. It hybrid means what? Hybrid means what? A mixture, a combination. So combination of what? Combination of two elements of finance. And what are those two important elements? One is equity and another one is debt. Equity represents what? It represents the ownership of a company. We can say na ownership of the company. And debt means what? It means borrowed money, a loan. So this hybrid finance is what? It is a mixture of two elements, equity as well as debt. So when a company wants to pay a debt, suppose let's take an example, company wants they have to pay the debt for 2 years, okay? Interest for 2 years. After 2 years, if they want, they can convert those debt debenture holders into their equity shareholders. So they have that kind of right by hybrid finance. So till the year they want to pay the interest they will pay, and after that they will convert their into equity shareholders. So now equity shareholders is provided what? A type of dividend. So it gives both of the you can say both of the merits. It will give the equity and debt. It will give the advantages of both the elements, equity and debt, in hybrid finance. So whole unit is about all these things. Okay. Before moving forward, when very important information, that is a mega webinar is being conducted on 9th of February. Okay, this is 2025. 9th of February 2025, and the time is what? 11 a.m. For what? For cracking, how to crack JIB in the very first attempt. So, three people, three most important people, that is our Pradyuman sir, okay, JIB and CIB faculty, then Nishant sir and Vineet Kumar Sharma. These three all together will give you the right strategy, right way how to clear the JIB exam in first attempt. So they will provide you all the step-by-step strategies, how to manage your time, what are the best resources, okay, the step-by-step strategies, and all the discussions will be there. So if you have any queries, you can also ask the queries. So do join this mega webinar. It is free of cost. So register now for this. Now, let's start. Let's go back to our syllabus, that is hybrid finance. So, hybrid finance, a hybrid security is what? It is again financial instrument which possesses both the characteristics. One is of debt and the next is of equity. So, it includes the features of both debt and equity. It provides investors a blend of fixed income, and these securities, they help the investors, okay, they can meet their investment needs. Am I clear with this basic definition of hybrid finance? So we have different types of hybrid securities. So first is preference shares, we have warrants, we have convertible debentures or convertible bonds. Next is mezzanine finance and foreign currency convertible bonds. These are all the same, okay, just it is being issued in any foreign country. Foreign currency convertible bond. So now let's understand one by one what are these hybrid securities. So first is what? The preference share capital. So preference, see, from the word itself, it is very clear that it gives kind of preference. Okay, it gives a kind of what preference to the holder. The preference capital is the money a company raises by selling preference shares to investors. So when a company sells their preference shares and investors who purchase and they give money in return of those shares. So it is a type of again a share capital. Okay, certain investors get certain rights over the assets and earnings, and as the name suggests, they there is a certain kind of preference. Most important, what is that preference? The preference is of having a dividend. That is when the company earns profit. Okay, how profit is being earned? Sales minus variable cost contribution minus fixed cost EBIT, then minus interest EBT, earnings before tax minus tax, then comes profit after tax or earnings after tax. Okay, so this is what? This is the profit. From this profit, okay, first we have to pay all our liabilities, all our debts. Okay, then next comes what? Preference shareholders. So from this profit, a dividend is given to preference shareholders, and after that, whatever is left, then from that profit, the dividend will be given to equity shareholders. So either dividend will be given to them, either the whole money will be kept as retained earnings, or a mixture of both has to be done. So, but the first preference of getting dividend is given to whom? The preference shareholders. That is why it is written up preference. So we have different kinds of preference shareholders. Okay, let's have a look in a very you can say precise manner. So what is cumulative? Cumulative preference shares means when you get a dividend all together. Okay, suppose in the year 2022, company made a loss of, let's take an example, minus 10,000. So this year's dividend, the company will not going to pay. Why? Because the company has made a loss of 10,000. Now, in year 2023, company has made a profit of 40,000. Let's assume that every preference shareholders they get a dividend of 5,000 rupees. Let's assume. So now what happens? Okay, so this year's 5,000 and this year's 5,000. Okay, so the preference shareholders will get a total of 10,000 rupees in year 2023. Why? Because last year there was a loss, so that is why company was not able to pay dividend to its shareholders. So in this year, company will carry forward the previous year's dividend and they will give the dividend to preference shares. So this will come under cumulative preference shares. When the word cumulative means accumulation of all dividends, accumulation of all previous dividend. So they will be get in totality of those dividend. Now, non-cumulative means what? Similarly, in this case, okay, in this year, company made a loss of 10,000 and in year 2023, company made a profit of 40,000. Now, the preference shareholders will be given dividend of only this year, not of previous year. Why? Because it is written non-cumulative, means they will not going to get the dividend of previous years. They will only provide a dividend there. They will only get the dividend of present year only. So only present year. Now, participating preference shares, these are those preference shares who will participate in every, okay, if any kind of extra profit is there, any kind of extra bonus is there, so they will also get those profit, those bonus. Non-participating, they will not get any kind of bonus, any kind of profit, only they will be given dividend. No bonus, no profit. Now, redeemable preference shares are those preference shares which may redeem after a certain period of time. So a period of time is being mentioned that after 10 years, okay, the you will your preference shares will be redeemed, or after 15 years. Likewise, the time period is given. So when the time period is allotted, then it is known as redeemable. It means that company will buy back their shares. That is redeemable. When company will not going to buy back your shares, okay, not going to pay you the money instead of those shares, so that is non redeemable. Means no date is being mentioned that when they will be redeemed. If no date is being mentioned, then that is non redeemable. So when the company gets wind up, when the company gets liquidated, then only they will be redeemed. So normally in India, non redeemable preference shares are, you can say, not allowed. Okay. So you can say at redeemable preference shares, okay, so they can redeem. A maximum period is given 20 years. Okay, within 20 years they have to get redeemed. Now, convertible preference shares. What is convertible? When preference shares can be converted into the equity shares. So they are known as convertible preference shares. Similarly, when it is written convertible debentures, then it means that their debentures are being converted into equity shares after a after a certain time. Non-convertible, again, when the preference shares are not converted into equity shares, it is non-convertible. And adjustable rate preference shares. What is adjustable rate? Means the rate of these preference shares will be adjusted. That is, it will be dependent upon the value will be dependent upon the market fluctuations. If the value in the market will increase, then fluctuation. So it will depend upon the market fluctuations, that is on the derivatives. If the value of the shares will increase in the market, so accordingly that they will get the dividend. If the value of the shares decrease in the market, so accordingly that they will get their dividend. So it is a adjustable rate. So rate will be adjusted according to the market condition, according to the market fluctuation. I hope this is clear, and it is very, very important. Types of preference shares are very important. Now, next is what? Warrants. Again, these are what? These are hybrid securities. So warrant is what? It is a kind of document, and it is a kind of document agreement which gives what? Which gives the holder. So one who hold the warrants is known as warrant holder. One who is holding the warrant, like one who is holding the shares, are known as preference shares or equity shares. Similarly, one who is holding the warrant is known as warrant holder. So this warrant holder, it is a type of, you can say, a legal agreement, contractual agreement between two parties. Okay, where the holder, that gives the holder the right to buy the share any company. Okay, right to buy the shares, right to sell the shares of any company at a fixed price, at a set price, the price which is mentioned on the stock exchange. At that price, okay, when the warrant holder is given the right to buy the company's share or to sell a company's share within a specific time period, that are known as warrants. Clear? So you can see over here, it is a derivative issued by a company. A company issues the warrant, and the one who purchased the warrant and they give some money, so they become warrant holder. That gives the buyer, so it gives the buyer the right, but not obligation. So remember, only right is given to you, not any kind of obligation is there on you that you have to exercise this tool instrument. Definitely no, no obligation is there, only right is given to buy the company stock at a certain price. Again, a warrant in finance is what? It is a contractual agreement that gives the holder, or you can say the buyer, the right to buy or sell a company's share at a set price at a specific time. Again, these are a valuable tool for the startups and investors. So those who have entirely a new business, so it is a good instrument for them. In finance, warrant are financial instruments that give the holder the right but not the obligation. This line is very important. It gives the holder the right to exercise the warrants but not the obligation to purchase a company stock at a specified price. And the price which has been specified, it is also known as exercise price or strike price. Suppose, let's take an example. Okay, one warrant is being sold for rupees 200. Now, this is what the exercise price or the strike price. Okay, at this price you have to purchase the warrant, or at this price you will going to sell the warrant. This is the price which is being mentioned over there. Now, next are convertible debentures. So debentures, we know what are debentures? A loan. Okay. So convertible debentures, when the debentures is being converted into equity shares later on. Okay. Suppose for 2 years, I will get the benefit of getting an interest, debenture holders. Okay. 2 years, I have got the interest. And after that, if the company says that, okay, now if you want, you can convert into my equity shares. So now I have the right, I can convert into the company's equity shares. So I will become what? Equity shareholders. It is what? Convertible debenture. If the word convertible is written before debenture, it means they can be converted into equity shares later on. So it is a type of loan. Okay. When you buy a convertible debenture, you are essentially what? Lending money to the company. So the one who lends the money to the company, they become debenture holders. It is convertible. That is the special part about convertible debentures is that after a certain period, you can choose to convert your loan into shares of the company. So loan can be converted into the shares of the company stock, that is equity shares. And interest payment. So if you are a debenture holder, so definitely you will get regular interest payment. So this is one positive aspect, that you will get regular interest payment. Now, next is what? Mezzanine finance. This is very, very important. But tell me before that, any doubt to anyone? Any doubt to anyone? Everything is clear to you all? Now, what is mezzanine financing? Mezzanine finance is a type of finance. Suppose, let's take an example. This is a borrower and this is a lender. Okay. This person has taken the loan from this person. Okay. This person has given, let's take an example, 50 lakh rupees to borrower. Now, when the repayment date comes, okay, borrower fails to repay the amount back to the lender. So what lender will do? Lender will say that, okay, you are not in a position to lend, you are not in a position to repay your money. Now I'm giving you the opportunity to convert it into my equity shares. You have got a opportunity that you can convert into my equity shares. So this basically, the conversion is done when the borrower makes any kind of default. If the default is done on the part of the borrower, then they get a chance to convert into the equity shares. This is what? This is a mezzanine finance. So you must be thinking why the lender will say that convert it into my equity shares. So basically what happens, if they will convert into the equity shares, so definitely they have to bear the risk of the company also. Okay. They will get a, see, the normal shareholders will get a more ownership of the company, but this borrower has done a default. That is why this borrower will get a less ownership of the company. So in this less ownership of the company, okay, the borrower is ready to bear all the risk, more the risk of the company. So this is one good point for the lender. And if there are more shareholders, then definitely the value of the shares will also increase in the market. This will be the second reason. So that is why the lender, mostly the company owners, they give this, you can say, chance to the borrower. Okay, you are not in a position to repay your loan. Now you have the opportunity that you can convert into my equity shares. So mezzanine finance, it is a crucial concept of corporate financing. particularly for companies looking for growth without diluting ownership too much. See, came na this statement. Every statement of Mezzanine Finance is very, very important for companies looking for growth capital without diluting ownership too much. So now in this case, this borrower will not be able to get more ownership of the company. It is a type of funding that sits between a traditional debt and equity in a company's capital structure. So traditional means the old type of debt. Another hybrid type of debt and equity financing that gives lender the right to convert debt into equity in the event of default. Again, this line is very important. So when the borrower has done, okay, so it gives the lender the right to convert their debt into equity when the borrower has made any kind of default. So this is the privilege for borrower also, and this is good for lender also, that they don't have to give their more ownership to the borrower. They can easily be converted into their equity shareholders with a less ownership. So that is why this particular line is very important. It gives what? The lender right to convert debt into equity in case of default. Understood the whole funda why this happens? No. This finance can provide higher returns to investors compared to normal debt. So from normal debt, okay, the investors will get from from comparison to normal debt, okay, so this finance can provide higher returns what to investors. So that is why more investors will come and join in this company. In the they will also see that, okay, investors are getting higher returns, so we should also go and invest in such companies. So with this, what happens, the growth of the company will also take place. Again, very important, mezzanine debt is often an unsecured debt. So, see, it is an unsecured debt. That is why it is being converted into the equity. Na? Otherwise, this lender has the opportunity that whatever this borrower has kept as collateral, the lender can sell all those things and they can get their money back. So that it is a type of unsecured debt. Means no security is being provided when taking the money, and it typically matures in more than 5 years. So the it takes almost 5 years to get mature. Okay, more than 5 years. So this was all about mezzanine finance, very important topic from hybrid finance unit. So we have covered mezzanine finance, we have covered convertible debts, then warrants, then all the types of preference shares, equity shares, preference shares, hybrid finance. We have completed all these things. Clear? Mm, yes. So that was all for today. So I have covered all the hybrid securities in one video. I hope you like the video. So, and once this video gets over, I will upload the PDF. So you all can download the PDF easily and revise it when you get the time. Let's join tomorrow at the same time, that is 8:30, for next topic, for new topic, new unit of module D. Till then, take care, everyone. Goodbye. I hope you have enjoyed the session. So please do like the video and share it with others as well. Keep studying, keep watching. We'll meet you tomorrow at the same time.